en Estados Unidos, pero también a escala global. Vamos a hablar de todo esto con Jay Pelosky, está ya conectado, es fundador en TPW Advisory. Jay, hi, how are you? Good afternoon.
Hi, Marta. Good afternoon to you. Nice to be speaking with you.
The same. Jay, next week, all the attention will go to the Federal Reserve. Are the 75 basis points a done deal?
Yes, I think so. I mean, the markets, I think, are actually starting to move off the Fed focus. It's really been the focus all year, but I think at this point, clearly we're in earnings season, and earnings are having a big impact on the markets, as well as the data flow. I think we're getting to the point, Marta, where the Fed is priced in, right? The market is priced in about a 5% terminal Fed funds rate early next year, and 75 basis points in next week, 50 basis points in December, 25 basis points at the beginning of the year. And I think that's all now pretty much fully in the price of assets, whether it's stocks, bonds, or currencies.
Important too, if the Fed maintains this hawkish stance next week, will lay the groundwork for interest rates reaching 5% by March 2023. It's a movement, Jay, that seems likely to lead to a recession in the US, but a global recession too. How do you see that?
No, we don't see a global recession, Martha, and we don't think a U.S. recession is likely either. I mean, I do think it's notable that Bloomberg, for example, came out saying that their recession model suggests a 100% chance of recession next year. I mean, that's pretty aggressive. The consensus is about 60% chance of recession, and we note that Goldman Sachs came out suggesting that they think a recession next year in the U.S. has only a 35% chance. We're kind of in that Goldman Sachs camp, basically for a couple of reasons. One, there are no major imbalances in the U.S. economy, whether it's the consumer, whether it's corporates, whether it's the banking sector. All three are perfectly in good shape. And that's roughly the same around the world, by the way. So we don't subscribe to the idea that there are systemic shocks out there that are threatening to topple the financial community or the global growth outlook. And the second point is that we are believers in a high nominal growth world, and we think that that's really the key difference between the current environment and, let's say, the last 10 or so years post the great financial crisis. The 10 years after the GFC were basically low growth, low inflation, low rate environment. We're now in a high inflation, high nominal growth, high interest rate environment. And that high nominal growth provides a cushion for the economy. And so while the economy growth is likely to be slow next year in the US, in Europe, and globally, we think the odds of recession are actually kind of diminishing. And we're starting to look into 2023, and we're of the view that 2023 is going to be more of a year of stability after a crisis-filled 2022.
And Jay, is there a risk that the Federal Reserve does too much, that the Fed goes too far?
Well, that's always a risk, Marta, but I think it becomes less of a risk as the evidence piles up, and the weight of the evidence that inflation is in fact coming down and is under control, and there are no unanchored inflation expectations, right? The Fed is afraid of inflation expectations becoming unanchored and kind of getting into the wage price spiral fears. And there's been a lot of work done recently that suggests that those fears are unfounded, and it's actually quite unusual for inflation to become embedded into the wage price spiral. And so I think that the fact that inflation expectations are well anchored, if you look at the 3-year, the 5-year, the 10-year inflation break-evens, there's no sign of unanchored expectations. If you look at consumer inflation expectations, like from the Michigan survey or others. No sign of unanchored inflation expectations. And so I think that, plus the fact that the data is starting to come in confirming that inflation is rolling over and is likely to decelerate, that removes the risk of a Fed that goes too far and breaks things. And again, that's why we're starting to build the case here at TPW Advisory, building the case for a more stable 2023, which we think will be good for risk assets after what's been clearly a very volatile 2022, in part because of a very aggressive Fed rate tightening cycle, leading to one of the worst years for stocks and bonds combined that we've ever had in the past 100 years of market history. So we're hoping for a better year as we move into 2023.
Jay, one last question. This week, big tech are the main role in the picture of markets. How have you seen all these earnings with the big tech in focus? Amazon, Apple, Meta. What do you say about it?
No, it's an excellent question, Marta, and it's really a key for the markets. And basically, it seems as if big tech is going X growth, right? These are humongous companies now, these top 5 companies. They make up 20% or more of the S&P. And so it's really hard for them to keep growing, right? Particularly at an elevated rate. And remember that they're comparing to kind of the COVID era when people were locked down and spending so much more time online. So the comparisons are obviously always going to be tough. But I do think the case can be made that big tech is becoming less about growth and more about almost like utilities with, big cash flow, paying big dividends, buying back a lot of stock. And so what it does, I think, is it opens up an opportunity for new growth sectors to emerge. And we think those can be found in the climate space, in the innovation space. So the things, the innovation technology, the climate, clean tech, clean energy tech, that's the space where we think new growth is going to be found. And you can actually see it. Small cap growth is outperforming big cap growth in the US in a pretty significant manner. And then one last point is that growth is now found in the energy space. So it's quite interesting to note we've had a complete switch where for a decade or more, big tech was the dominant factor and energy became 4%, 3% of the S&P. We're now at a point where that's starting to shift. And the energy stocks are having fantastic earnings, and they're becoming now 6-7% of the S&P as the big tech percentage starts to come down. So a couple of things. One, big tech is growing X growth. Two, kind of traditional energy is becoming a place where you can find growth. And then three, we think the climate in the innovation tech space and small cap growth basically is where you're going to see that new growth opportunity. And you're already seeing investors move there. Just look at small cap growth versus big cap growth in the US, and you can see that small cap growth is outperforming.
Well, that's the key point right now. Jay Peloski, thank you so much.
Thank you, Marta. Have a great weekend.
Bueno.